Hello, welcome back. My name is Dr. George Mochocki, and today we're going to be covering Chapter 7 within corporate finance. This is Management 218. You're taking me for an online class, face to face, or a blended class. We're going to talk about stocks valuation, just in general. All right, now I usually try to keep my recordings under 20 minutes. This one may be 30. There's a lot of items that we want to at least touch on that you should be focusing on in your reading. Make sure you utilize the book. The author did a real good job. Use my finance lab by Pearson. Gives you videos, gives you a little more explanation. It'll look into Blackboard course management system under weekly assignments. I have different videos about inventory, turnovers, about different stocks, how to invest in stock markets, real short ones, plus utilized YouTubes and videos presented by the publisher. Now, this is just going to be a quick overview, areas you should look at. Okay, so here's what we're going to be talking about. Now, I'm going to try to do this because there's a lot of information here. We got two classes of stocks, basic stocks, some features of preferred stocks, investment from Investopedia, web, some information they use, some cash flows, how to use the stocks to generate cash. I'm selling stocks or I'm buying stocks for the dividends and some information on that. Measures in investment, different stock markets, what's the NASDAQ, clean up the street. This is an interesting chapter. This is something that most of us always want to buy stocks. Remember, we were talking about bonds earlier. Stocks and bonds are both like sisters. Bonds are the stepchild of the stock market, but most people are more familiar with the stock market because you always see that on the news and everything else talking about different stocks. Okay, so let's go into this. I think let me see what I have in here. Let me make this zoom in at 200. So it's going to be a little bit larger, and you should be able to draw. First of all, remember, I'm just going to go over generally. You should know that there is, part of the quiz and exams. You have some definitions and how to solve some problems. Always utilize my BizLab. Click on where it says resources, and for the chapter, and they'll have either Excel spreadsheets. They'll have how to use the calculator. They have short videos showing you how to do the problems by hand. But mostly right now, as the problems are going to be more complex, longer problems, longer work. It's a lot easier to use the Excel spreadsheet or the financial calculator. Okay, so you have two classes of stocks. We talked about common stocks and preferred stocks. Right, common stocks are owners. Preferred stocks basically give up something. You don't have any ownership, but you're guaranteed that you will always have a payment if there is any kind of profits or what's converted into a dividend. Now, so it must have basic forms of share and profit. If they remember, both of them have received dividends, whether it's a preferred stock or a common stock. The only thing when I do preferred stock, I give up my voting rights, but I'm always guaranteed. Let's see. Always guaranteed that I will get dividends before it's distributed to the common stockholder. Preferred stock can also make sure you look at these other options. Callable, I can pull it back. Convertible, I can convert it back into a common stock. Once I convert it, I can't go back. And cumulative, basically, that the dividends. If I didn't make any profit this quarter, I don't have nothing to pay. So in common stocks, okay, I understand that, no profit. Preferred stocks, I gave up my voting right, so it's cumulative. That means the minute I start making up or start having what do you call a profit, which I convert into dividends, I have to pay all the in arrears of the dividends that were not paid out to my preferred stock. That's part of the terms and conditions. Okay, basic stocks. Let's go. You have features of a stock. You have a class of a stock. Class A, sold to the public. Class B, sold to founders and managers. Has a little different terms and conditions. And depending on the policy, how many directors can vote for it. And this one here, I just remember I'm live. I don't change. Voting rights. Straight has a vote for each share. Cumulative basically is allocation for the number of directors, shares times directors, and that's basically will fall into my Class B stock. Proxy voting, either vote directly or vote by proxy. It's like, do I want to go to polling to vote for the president coming up in the 220 or my elected officials, or do I just send in a mail? And so proxy makes it a lot easier. You can still vote. You'll get the form, you fill it out, and you send it out, and you have to seal it and use the envelopes that they provide you. Those of you who have stocks, real quickly, we talked about that in our class. Other rights is share proportionally in declared dividends, share proportionally remaining assets, and a preemptive right basically means first shot in new stock issued to maintain proportional ownership. All right, so look at in order in that. Okay, reading stock quotes, see the back of the sheet, separate mind map. I presented that to you. Okay, advantages and disadvantages of common stocks. Let's just make this a little bit bigger here. Oops, sorry. That's easier. Hang on. All right. Okay. So what are some advantages? Some of the advantages is that you have, for lack of better words, shareholders are owners of the firm. Never had to be repaid for towards the investment. You sell it. You buy the house, you sell it, or you keep it. Hopefully the value goes up, and if you need the money, you can turn it on. Remember, you have to, part of the stocks options you have is either dividends or you're looking at growth. Some stocks and company ownership, you get both dividend and growth. Some you only get more of the dividends because the investments is so long, you may not make up that investment amount. So remember, you have two things. Whether I'm a homeowner, I can own a home and have a rental property. So now I own the property. As the home goes up in value, the rental property is my dividends coming in. There's no legal obligation to pay for the dividends. I have voting rights. This is the same thing if you look at Google, what's going on. They're trying to, the shareholders trying to kick them out, and there's a possibility they could do it. They think is leading the company the wrong way. And if you look at the Google stocks now, it's took a real big plunge because there's an antitrust with the government trying to make the company smaller, saying it's too big, controls too much. Okay, and does not create that. Okay, now disadvantages: dividends are paid from after tax or profit. So we talked about and are not tax deductible. So you know, the bonds, I could have them tax deductible. Municipal bonds or certain bonds that are issued, I could have pay no taxes on that on my what do you call it? My return, not dividends, but on my interest rate that's paid back to me. Management works to keep the stockholders happy, and you can find that in annual reports. Stockholders have right to vote for the company's board of directors, not the management. We talked about that in management into the business. What the basic things is that the board of directors does not create the management. Board of directors, you vote for the board of directors, not for the management. So if you don't like the president of the company, you can't get rid of the president of the company. You have to get a new board of directors, and they will be you select board of directors. They're going to bring the management or the policies that you're looking for. Issue new stocks can alter the control of the firm. The more you issue, I have more owners, so I may lose some of my. If I don't no longer, if I don't watch myself, I don't have 51% of the shareholders, I could be voted out. And you see that, and we talked about that before. Okay? Now, features of preferred stock. Dividends, again, stated dividend must be paid, and that's usually on the par value on the dividends is shown in there. Paid to the stated dividends must be paid before paid to the common shareholders. We talked a little about that. Most preferred dividends are cumulative. We talked about that. That means if we missed anything, any of the preferred dividends, you have to pay the preferred because they gave up the voting rights first before you give any dividends to the common stockholder. Now, I'm opening these up and not going into real detail because the book and the reading and everything else has that. I know I'm going a little bit quick. I'm trying to keep this underneath a half an hour. I got 15 more minutes. I've got a lot to cover. Non-cumulatives do not accumulate. Remember, there's part of the things that you have to look at is the terms and condition, even on preferred stocks. Is it callable, convertible, some of the features. So all preferred stock, all common stock, like any kind of thing, is you could have some adjustments depending what you want to do. When I look at common stock, IPO, initial public offering, that basically means that anytime the company wants to generate more revenue, instead of going to debt finance and DEPT, it goes into equity financing. It sells some more shares of the organization, and they inform their current shareholders what's going on in the annual report. That's the message that I talk, or to letterings or mail to the stockholders. Because the stockholders feel that the stock is going down, they're going to start selling it. They start selling it, the value goes down, and some people buy it, figuring it's going to go up, but it's a gamble. Okay, okay. So now this one here, I'm not going to go into much. Investopedia, similar. Try. It's just some links on here. Remember, I opened up for those that are looking at it. Copy the link. Stop me. Click on the link. You've got my concept map. You have that. Top financial news resources. These are all of them, and I just open them up to here. The basically, if you don't have the website. So those who are looking at it, and this is basically where you get the information. Yahoo Finance, Daily Finance, MSN Money, Forbes, Dow Jones, and there's another one I can't think of it right now, but there's other ones that you could look at. Your insurance company or your stockbroker. There's many out there that you could. You don't have to use these. These are just the most common ones. Okay. Okay, cash flow. Cash flow, basically how much money you have coming back to the shareholders. If you buy stocks, can you receive in two ways? You either shoot a dividend, or you sell your shares. You need money. You sell your shares, hopefully more than what you paid for 'em. Or if it goes down, you want to at least break even. You want to lose any money. And then this is just the problem we worked out in the classroom. And if you're looking at your calculator, here's how you solve it. Press the button. Here's the problem. Here's how we solve it. I just throw that in because a lot of you make sure you use your concept map. The concept maps basically gives you a quick overview and outline. Instead of 60 PowerPoints, you have this, and you add into it, and it's a quick reminder. You look at the sheet. Oh, this is everything I should know about stocks. Okay, and remember, in my Blackboard course management, I recommend MBABS. There's a site, and he does a real excellent job on bringing it to the real simplistic terms. And when he says BS, he means he gives you the core of what's going on, preferred stock, or how to solve something, and then all the other terms and conditions or different aspects you could add on to it. Is what he calls BS. Okay, but you need that as you're going forward, as you go, as the company's growing and you're doing more investments, or you're a financial manager trying to see which is the right way. Remember, a lot of financial managers, they also buy stocks in either their competitors or some other companies as a stream of income. If they need money, they'll basically sell it off instead of taking out a loan. So they're using that as a return on their investment. They keep it in a bank, or they'll put it in the stock market, or they'll put it in a commodity like in gold, some derivatives, and we'll talk about that down the road, a little other concepts. Perception of the stock market. Make sure you know I don't come up with these. The bull market basically is the bull. Investor believes the stocks are going right. Right now we have been beginning having a bull market ever since President Trump came into the office. Oh, President Trump, don't mention his name. Hey, I'm a business person. I don't care if it's President Obama, President Trump, if it would have been Hillary Clinton. What's going on in the market, and what effect do they have? Does it bring confidence in the market right now? Whether you like it, they have the Trump effect, and Trump is basically have a bull market. Now we've had a bull market for 2 years. Was it able to survive, or is it ready to slow down and become a bear market? Investors expect the stocks to what? To basically start declining. Are we at that point? We've been in a bull market pretty much. That bull's going to get a little tired. I'm not saying, but these are the things that financial managers are going. He said, okay, maybe he may still make it. Maybe he's going to keep the economy going at least to 2020. This election's coming up, and even further. Right now, I think part of his campaign. I'm just throwing this out. If you're looking at this 2 3 years later, it's like, well, what the heck is Dr. George talking about? But he's saying right now, if you want the stock market economy to be strong, you better vote for me. I think that's a pretty good message out there. You either agree or not. Remember, any politician has the good and the bad. I'm trying to look at it from a business perspective. He's good for business. Lower regulation, lower taxes. He's also good for me as a consumer. All right, so am I able to spend more money, disposable income? The more money I could spend, the better it stimulates the economy because I got extra money, I could buy stuff. If I'm just breaking even, look, I'm thinking as a financial manager. I'm thinking of a company. How do I bring other income in? What's going to basically, how do I diversify to take me through anything that's going to happen? So I don't want to keep all my eggs, all my money into one commodity. I'm all over. Do I own companies? Do I expand overseas? Do I sell here? All the, and stocks doesn't necessarily have to be in the U.S. You could buy stocks, foreign stocks also. The European Union. There are companies that are out there that can buy stock. If you're buying international stocks here in the U.S., you're basically buying through the New York Stock Exchange. They're the broker, for lack of better words. Okay, buying stocks on margin with borrowing some of the stocks on the purchase cost. It's almost like the leverage. If it a margin, look, when I buy a house, do I pay the full amount? No, I only pay maybe 20% of the rest. I take a loan out. All right, so that's basically the same thing from a brokerage firm. Okay, margin is a portion, must pay with their own money, or the stock's purchase price of the investor. If the broker issues a margin call, they want all the money to come up. No different than on a mortgage. Look, the mortgage, I've got the mortgage loan, but the bank may say, hey, sorry, George, we need the money now. What do you mean I don't need the money? Take the loan. Sure. Usually, what they'll do, they'll sell my mortgage note to somebody else, but part of the term and condition, they can say now, or they'll take the house away. That's part of life. I mean, so this is kind of similar. Like we talked about this in class in a discussion. I'm just giving you a quick general overview. All right. I got 10 more minutes. I'm watching my clock on the side there. Okay. What else do we have here? Now, Nasdaq. Nasdaq is basically it's not a physical like the New York Stock Exchange, right? It's basically or American Stock Exchange. It's basically an online exchange, but they have the board so people could kind of look at it. Electronic is level one, basically medium quotes registered representative. Level two, view quotes brokers or dealers. Level three, view and update quotes dealers only. Large portions of technology are technology stocks on the Nasdaq. Come on. I'm an internet company. How else would I do it? It doesn't make sense, okay? Now, the different stock markets, you have the stock market, dealers versus brokers, a dealer's agent who buys and sells securities from inventory, broker's agent who arranges security transactions among investors. Now, if you look at America Trade and all that, they're kind of a broker for a very small fee, where other brokers basically they give you advice and you give them the money, or they take your money and they say, hey, we'll invest for you, and you're looking at their expertise and their resources and research that they've done in certain companies. On, and there's your insurance company, like a USSA insurance company. I could buy stocks and shares through them. Doesn't cost me anything, a very small amount. They're like a broker, just an agent, okay? New York Stock Exchange, again, members, operation. They're the oldest. You have to be a member to sell. Own seat on the exchange. If one has to sell, the seat before you could go on there. Largest in the world, floor brokers, execute orders for common brokers, specialists. Let me just move this over here for you. Acting as a deal in securities and exchange floor, and executes buys and sell orders from customers, and floor traders. Let's see. There we go. Trades his or her own account. More information, just general. These are terms. Some people talking, you say, what the heck are they talking about? What's a floor broker? What's a specialist? What's a commission broker? What's the New York Stock Exchange? What are dealers and brokers? Information that you learn in finance. You should know some of it. You're not going to remember all of it. Trust me, I got this video, the book, everything else. This is your first exposure. You're at a community college. I'm just exposing you to the terms and condition. I'm not. Remember, we're still doing the math portion, but the whole thing is understand the language, understand what terms are. If I understand what's going on, what each member does, what they're doing, I have a good idea how to solve the math, or understanding what is going on with that individual stock that I'm purchasing, or what's going on with their organization. And remember, we're going to talk later on. You have private and public. Private means that hey, public means all these people here in New York say all they give them their evaluation of the stock. So stockholders, I'm not doing what do you call it? The New York Stock Exchange is going down. It's giving me some input. All that information, the financial information, everything about the company is public knowledge. Private, they pull back because they say we don't want to listen to Wall Street. We want to be private. You still could buy shares and everything else, initial public offering, but you're not buying it in the exchange. You're buying it over the counter. You're basically dealing with the company per se and buying the stocks from them. No different than a mortgage. I could use a retailer that's my agent broker here, or I could just buy me as a homeowner and say, hey, I want to buy that. You want to buy my house? No retail cost. Boom. I'm saving you 5-10% because I'm not going to charge you that, and you can buy directly from me. But what happens? My house is just limited. When I do a retail broker, everyone worldwide or in the United States could see the stocks for sale. Here, I had to really go, or you have to go searching for me. And some companies want to do that. They pull back because they want a long-term strategy, and they don't want everyone just telling them what they should be doing, what the prices should be doing. Okay, measure of investments. Let's see what we have in here. You have the Dow Jones average. It shows direction of the market. 30 blue chip stocks. Remember blue chip stocks? These are the ones from, I don't have the date on here because they come and go. You know what I'm talking about? Exxon, oil companies always there. Home Depot. Home Depot is kind of all right. I think is dropping down on there. Johnson Johnson's having a little problem. And all I'm doing is just remember these change. These are the original ones, and these are the new ones. Microsoft's still doing good. Nike had a little issue. They're all right. Procter and Gamble. Remember, the blue chip. I'm a blue chip stock. Look at Kmart. If you look at Kmart 20 years ago, they're the number one thing. No one could beat them. Kmart's the biggest. Now what do you got? You got Walmart, a Target. Kmart's like they've been closing stores. Same thing as Sears, Icon, number one. Now it's all of a sudden just falling apart. Would Sam's fall in the same thing? Who knows? Amazon, but they're trying to survive. So remember, the blue chips are what's going in now. So if these companies here are struggling, odds are the smaller stocks, the penny stocks, they're also having, or the riskier stocks are having some issues. Okay, all right. Now, what do we got? Stock quotes, and again, these are the things you should know. Percentage change in yield, high-low prices, dividends, profit and earning ratio, shares traded. How many shares are traded? If I see all of a sudden a lot of shares traded, wait a minute, why are they trading? It's like all of a sudden I'm in a neighborhood and all the homes are going for sale. I go, oh, something's wrong going on there. Or the homes for sale because the property value is going up. Closing prices. That's what you're looking at. Microsoft chart, and there's some disinformation on Microsoft. What you're looking at, it has everything else. How many they closed, the bid, the volume. And this is what you're looking when you're looking at an investor. I'm talking about most common individual investors. I may own maybe 10, 15 shares, 10, 15 different companies, or maybe two companies, maybe one company. That's all I'm tracking. I don't care about, but I'm tracking them in the industry. First, I got to understand what's going on in the environmental, the forces affecting the company or the industry as a whole. When we look at somatic or unsomatic risks, for lack of better words. One affects the whole industry, one just affects the company as a whole. Those are all values I'm always keeping an eye on in the industry. So if you're diversified and you have some tech stocks and then you have some utility stock, you're watching that market and then you're looking at the different companies and comparing them. We talked about different ratios on here. Okay, that's good. Ups and downs of the market. What do we have in here? Program trading. If I'm looking at this, give instructions to computers to train automatically. They gotta be quicker. This computer, see, you can fool the computers, but all of a sudden you see a run on it because somebody owns other stock, and all of a sudden computer says we should sell now to get a lower price because they think the value is going down, and then basically you flip on. I think some of the regulations are going to try to get away with the computer selling. Look at the computer selling. It's like eBay. I go eBay. Here's how much I want. If it drops down this amount, sell it. If it goes up on this amount, if I could buy it at this amount, keep it. If they keep on raising up for 10, 20, forget it. I don't want to buy it. You put the instruction on it. Analysts believe the program trading caused a turmoil in 1987. I'm dyslexic. The exchanges created mechanistic to restrict program trading. I mean, there's the laws coming in on that because they could play it. Remember, if I'm selling a lot of value, the computer doesn't know what's going on. Just say, oh, what's going on? There's a run on this. People are selling it. That means something happened. The stock price is going down. Let me get out of here so I don't get stuck and lose my investment. I paid $50 for it, and it's worth 75. And if it goes down past 50, get rid of it. And the computer will do that. But I can manipulate that with other computers program. Welcome to to our technology, AI. Okay? All right, what do we got in here? A dividend model, if a discount model, 1 year investors, basically dividend yields, capital gains, total return, multi-year investor, dividend discount model equation. We talked about the discount model. Remember, we're looking at discount model, how much the stock is worth in the future, and what we assume in the future, and we discount it back to see if we have it makes sense for us to keep this stock. Okay, now who's at fault at the crisis? Okay, Wall Street, Main Street, Washington. I just opened that up. Okay, so everyone remember when we had the crash. Now, if I'm looking at the stock market when they crash, remember the stock market, if you look at financial, it goes through cycles like a business goes through cycles. Remember, a growth, maturity, and then decline. And stocks, when it goes to to wipe it out, whether you like the central bank or not, that's they're the ones playing it. They keep on expanding money, expanding money. Eventually, it corrects itself and you start from the bottom. So you have to look at it. If I think the market's going to crash, I get my money out of the stocks, I put it in bonds, or you see people now, they're not sure. Right now, they're pretty safe with the Trump administration that's going on. Good economy, they're keeping it in there. But let's say after the election, if you get if Trump doesn't win, I'm not saying one way, but if I get a Democrat, someone that's a real leftist on the other side, I'm a business person and wants more regulations, more taxes, everything else. I'm going to say the market's going to go down. The stock market's going to go down because people won't be able to invest. I try to pull out my stocks before that happened, or once that's what they said when President Trump was elected. They said, oh, the market's going to crash because he's going to throw everything out into haywire. No one's going to, there's going to, no confidence in the administration going forward. That did not work out. You see the gamble, and I'm just throwing that in there. So most of us been through this. So you have to be able to understand your perception. Remember, these are analysts telling you what's going to happen, but then you have to look at it. Oh, it didn't happen last time with this guy. Did it happen with Obama? What had happened? But see, that's something you have to decide. Now, companies have the algorithms that are basically looking at the different scenarios and let the computer kind of decide. Doesn't mean it's going to be right, because remember, you don't. You're just anticipating what you think the perception of the stockholders are going to be. Oops, I better get going. Sorry, went a little bit too much. And then Main Street, basically Americans live beyond their means. I'm one of them. Lenders give favorable loans to home builders. Greedy homeowners took out equity loans. Be careful. Remember, if you've got credit, it makes sense to take an equity loan because then you could write it off so far unless the administration changes that. They're looking at dropping that deduction. And look, I had all the deduction, but then with the new tax rate for individuals as myself, basically, I didn't have to itemize. I made more money by not itemizing. You know what I mean? So things are changing. But okay, so equity loan. I got credit cards. I turn it over to take an equity loan. I pay off all my credit cards, and now I've got that interest payment is payable, a tax deduction, for lack of a better word. But what happens is when I say credit card, if I defaulted, what are they going to get me? I went out a lot. They just can't get it for me. I just get the creditor. If I put my home on an equity loan, what basically happens if I default, even by one or two payments, they could put me to foreclosure and say, hey, pay it off. Here's what you owe me. I'm going to sell off. I may give you some money, I may not, but you have no choice. Remember, make that. It makes sense to reduce your interest payments, everything else, through an equity loan versus a 16% or 15% credit card. But you look at the terms and conditions. What's going to happen? You put the house up for equity. So if you default, they basically your house is gone. All right. And T's are mortgage rates. I mean, they went with adjustable mortgage interest rates we talked about last time. Oops, sorry. But I got to go back to 3. Okay, I'm live in the program. Okay, you've got the Bailey Act, and basically what did they say? Allows commercial and investment banks to partners. These to be separate. Housing interest rates and community reinvestment is forced lending to people with bad credit. Yes, because you have some people, look, not that they have bad credit. I was through the recession. I finished my PhD, and now I owe money. And what happened? I would have did well if the economy was good, but it dropped down, so people didn't have money, didn't go to school, everything went down, and I was in that position, 80% to finish. Here I am, but I'm doing all right. Okay, remember, things happen. So if I'm looking at what's going on here with the community, I might have ended up with bad credit, or I bought a house and all of a sudden I thought it was going to be investment, and then the housing market crashed. So now the house is worth less than what I owe. You know what I mean? So no one's going to make it. So a lot of people walked away, or I had credit, or I lost my job. If I lost my job, how am I going to make a thing? I charged, and I was late on my payment, ruined my credit. Doesn't mean that I'm a bad individual. It's just because of the circumstances that happened back there. I had no control. It's like a catch-22. Catch-22, for those who aren't familiar, is I can't be, there's no way around it. I can't be charged twice for the same crime. If they found me not guilty, next time they find me, some new evidence, hey, I already pleaded, you already were found not guilty, we can't pull it back unless there's something different. I don't know why I just threw that in there. All right, now cleaning up the street, the Dodd Frank Day. Now this one here gave government power to seize and close large businesses. The problem with this is all changing now with the new administration. He's reducing it. President Trump or whoever his finance individual is, they're basically saying there's too much restriction. Okay, we should have in the large companies, but this also affected the smaller companies. I have to follow all the rules and everything else. That's what accounting was big. Nowadays they say, hey, George's little shop, he's got a little coffee shop, he got a ice cream parlor, he's got a little business on the side or whatever. It's not going to affect the economy. Let's look at the larger ones, okay? And then derivatives. Again, we'll talk about derivatives later on. I mean, here's the gold. And I said that's what happened to the housing market. I brought the market. Usually, it was the bank that controlled it, so they made sure I was the right person because they wanted the money. They didn't want me to default to make sure I could afford it. Now, it happened. They brought it and said, "We don't care. We got poor credit. We just sold your deal with a bunch of other houses to another investor." So they're no longer the holders of that. And that other investor says, okay, I got all these good loans, good and bad loans, and then they sell it again. So when you finally look at the other person that's investing, they got to go all the way down, and this person may not even have the house anymore. So the same thing, you got to look at the derivatives. Derivatives is something else. It's here's the main thing, and somebody else is buying off of it, and somebody else is buying off of that. We'll go into it later on, but I just want you to be aware of the concept. But man, that's interesting. I didn't understand it. Look it up. Look it up at Google. Look it up at other information. There's a lot of YouTubers out there that have that information. Okay, I think I'm kind of done with everything I wanted to cover on the stocks. Let me just bring this back. Expand to level one. There we go. All right. And now I just put it back in here. So we covered a lot of information, different stocks, basic stocks, advantages, features, preferred stocks, cash flows. Remember, money coming in, money going out. How do I get cash flow? What can I sell? Remember, stocks, everything else. When they look at the liquidity, how quickly I can convert an asset into cash, and that's long term. Remember, anything underneath a year. All right, and cash flows, perception in the market. Remember, you understand the bull and the bear. Buying stocks on margins, something like buying on a loan when you're working with the broker. You give him a certain percentage, but he could call back that margin call and say, I want the full amount, or I'm taking all the stocks back. Cleaning up, okay, NASDAQ is the computerized stock market. Just basic investment, measures in investment, stock quotes. Look at them. They're all basic ones. If you look at them, those are the ones that gives you a good indicator how much stocks are showed, what's the profit and earning ratio, what's the price of the stocks, is it going down, is it going up. Remember, don't look at the stocks market if one goes up, oh, I got to sell it. Stock market is for the long term. Stocks go up and down, companies go up and down, just like my income goes up and down, depending on the thing. But then it starts going down, 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 then you have to be worried. And this is what you're going to be doing from a major project in this course that you're taking me for. Okay, and the dividend discount model, I go forward and come backward to make sure that the value of the stock. We need to get the valuation of the stock. We're just giving, market value and perceived value. Right now, just the stocks in general, and how do I clean it up? And that's what the government gets involved, or what's the government doing now? Okay, so let's see what we have. Again, curious. Let's see, recording, 33 minutes, perfect, half an hour. Again, my name is Dr. George Mochocki. This is community college you're taking me at, and this is corporate finance, management 218, or if it's another school, it'd be a finance class that teaches several schools. All right, I just use this one. The chapter 7 is basically stocks and stock valuation. What's the value of the stock, and which stocks would I buy? And remember, penny stocks are good right now, but you're hoping that the company's going up. All right, so again, thank you again for taking this class. Look me up, and I was going to say, look at Patreon, those who want to help me pay off my student loans. I'm kidding, all right? But if you have any money, you got no place to go, I'm your person. Again, what I wanted, and the reason I'm looking at this is because you're looking at this, how do I, remember, debt financing or equity financing. Equity financing, something I could sell, my garage sale, I could sell stuff. Debt finance, I got to take a credit, a line of credit. In business, I'm not trying to get away from one or the other. The new administration is trying to get us out of debt financing and going with the equity financing. Have the cash first before you buy it. All right, it's the best way to go. But in business, I gotta buy inventory, everything else in advance. I need the line of credit. I'm building a house. I take a short-term loan, construction loan to get the house done, and then I figure I could take a longer loan. But I need the money now, so I'm paying a little bit higher interest rates, a little lower interest rates, but it helps me. Do not remember, in finance, in business, it depends what's happening. Just like in our personal life, car breaks down, I have no choice. Got to take a loan. If I know the car is getting old, I start saving the money. I get paid cash for it. All right. So again, thank you for taking this class, and I'll see you in our next chapter. Bye. Oops. Let me turn this off.